Welcome to Truth in Lending, America's coolest, hippest mortgage and real estate news podcast. For over 3 years, millions of Americans have gotten to ignore that pesky bill from student loans, but Uncle Sam is knocking on the door in October. Today, we're going to dive into all things student loans and how Genene White with My Loan Sense can help your clients despite the lingering student loans. Today is August 9th, 2023. Welcome to Truth in Lending.
Awesome. Welcome, Genene. Where are you visiting or joining us from, too? I'm trying to remember what state you're in.
Oh, I'm in Colorado.
Colorado. Okay,
Yes,
perfect. So
beautiful.
we're on the Pacific Coast time. So give us a little bit about who you are, your background, and what led you to My Loan Sense.
Absolutely. So thanks first for inviting me today. I cannot wait to share this message with everybody. My name is Genene White. I'm the lender account manager here at Loan Sense. I actually have been in the mortgage industry for 33 years. I started programming for Fleet Mortgage, their very first pricing engine. I moved into the processing and then a wholesale account executive for Bank of America till the implosion of 2007. And then I had to reinvent myself and I ended up going into operations and underwriting. So I actually was a SASE coordinator and I actually underwrote for Loan Depot as a
All
jumbo
right.
four, as a jumbo level 4 wholesale underwriter. And I loved it. So yeah.
I love hearing people
And
that
when I decided, to move forward in the career, wanting to stay in the industry, but wanting to truly help people. That's what led me to Loan Sense. I met with the co-founder and found out how we could actually help not only our consumers, but we can help our loan officers and our lenders close more loans while helping people get financial security. So that's really what drove me here was the excitement to actually help somebody and see it.
Yeah. I
In
think that's
relative.
I think that's what I really loved about just getting to understand this product. So it was My Loan Sense was brought up to me actually by a realtor that had mentioned, is this something that you have? There's this student loan repayment. Like, do people understand what that means or how that works? And I was like, what are we talking about here? Like, so my experience in student loan repayment is it's just so complicated, and trying to explain to someone how to get the process started is just really overwhelming. So how many repayment plans are there? I mean, can you give us some
Yeah, I
background
can
on
tell.
that?
Absolutely. Yeah. So there are several. So just under the IDR, the income driven repayment plan bubble, there are four just for direct subsidized loans. Then if you have FFEL loans, that's another product and they have three others. Then if you have Parent Plus loans, they have two others. And there's another whole PSLF. So you are absolutely right. It becomes very complicated. Why is it so complicated? That's such a good question. Well, and it's due to the fact that they are federally backed loans. The DOE does back these loans. These loans have been in existence, these income-driven plans, since 2007. So they've been completely funded since then. And the servicers, they handle just as really the direct subsidized loans in the beginning. They can't apply. A borrower cannot call a Nelnet and say, I want to be on an IDR plan. They won't do that for them. They'll direct them to studentaid.gov. Studentaid.gov. And I love talking to loan officers and to realtors and people in our industry about this because it looks like a matrix of a loan program or overlays. So they have to go into each of these programs to see if they qualify. And then the onus is
Mm-hmm.
on the borrower. And then they have to fill out the documentation.
So
Unfortunately, 83% of them get denials.
yeah.
And that's what we're here for. We're going to take out that complication and that time that's going to take that, it's time consuming to go through all of those guidelines. And that's what we're going to do for people. We're sort of like, in a way, this is kind of corny, but I'm going to say we are like the TurboTax of student loans. These are
Uh-huh.
required to be filed annually. So we are here to take away all that complication for people, for sure, because
Interesting. So
it's government
with
backed.
student loans, you have to do that annually, like a review annually.
Yes, that's one of the reasons why our GSEs are accepting it. Fannie Mae has already clarified their position. It is posted within their articles. And Freddie Mac is also clarified their position, but they're actually going to be clarifying it a little more. Yeah, they will be required annually, like federal tax returns. So
Hmm.
it actually, the
Interesting.
GSEs are accepting the IDRs because they do not create payment shock due to the way that the calculations are done. So, and just like an IRS tax return as a lender, we're going to take your Schedule C, your 1120, whatever that income is, and we're not going to have you recertify that the following year because it is required by the federal government to be filed each year. IDR programs are federally backed and have to be filed each year. And the
And
debt
IDRs
goes,
are income driven repayment
yes,
plans.
sorry about
What does
that. Yeah.
GSE stand for?
Those are your government secured entities like your Freddie and Fannie. They purchase all the
Gotcha.
loans. Yeah. So on the
Uh-huh.
secondary market, they're going to purchase your loans. And they're the ones that their AUS is there. So they're going to be the one dictating what documentation your underwriters are going to be able to accept in order for the loan to be purchased. With them
Gotcha. It's so
backing,
funny. It's like with us lenders, it's like you're speaking the language that we talk, but it's just different enough that it's hard to follow.
yeah,
So
it's just a little different.
that's
But yeah,
perfect.
so this
So
is
so
when the
kind of
process.
recapping what my loan sense does. It's like you're going to I even think of it as like a loan officer, right? When you're trying to figure out what is going to be the best payment for you, you're going to talk to my loan sense, then they're going to assign you to a loan officer essentially related to student loans, and they go through all the matrices to see what repayment plan is going to make the most sense to find you the most
Mm.
affordable one,
Yeah,
right?
that's
So
a
there's
very, very good explanation.
because there's so many different loan programs in mortgage lending, and the same is true, it sounds like, for that repayment plan. And so for a loan officer, it's kind of fun that you did this as a tie-in for a loan officer, because you get that ability to say, well, I need you to qualify for a home, you want to qualify for it, and you're currently not paying much, but if we have to assume that percentage that of a payment, like how can we best maximize that, even if it's not maximizing it to qualify for more, it might be maximizing it to reduce debt to income ratio. Because if we can get, what we're assuming on the debt to be lower, then maybe that debt to income ratio, and mortgage insurance would specifically play into that. So there's kind of a lot of factors that if you can set someone up on a plan that's going to specifically get them the lowest confirmed monthly student loan payment, then they're going to
Yes,
benefit in a lot of other ways. Um,
absolutely.
so and we'll keep it short. What is your favorite like client story of someone that you've personally gone through or helped or
Absolutely. Well, with Loan Sunset, just to kind of level set, what we do for you as a loan officer, we will actually, our software will actually help show you what you can reduce that payment by. And it is all automated. So it is something that can be done very quickly. Some of the best stories, and we've recently had two that I just, one is sad in the sense, and I'm going to use this as a public service announcement to everybody on the call. If you have a client that has federal student loan debt on their credit report and there's 15 different trade lines, please do not refinance them or consolidate them out of a federal program into a private student loan. The reason why I say this is the
yeah.
minute that they come out of a federal program, they can never come back in into it. They go private, they can never come back to federal, so they lose all of their interest subsidies, their ability to have forgiveness. So, an example of this story, we just had a young lady. We are working with a lender, and we did a CSV analysis for them to reach out to people that they had not been able to help in the last quarter due to DTI or boosted affordability issues. When the loan officer
CSV.
reached, yes, exactly. When the loan officer reached back out to this person, sadly, she had already been contacted by a private lender. That private lender had convinced her to refinance her loan. Now, this person made $350,000 a year, but she had $380,000 in student loan debt. The payment that this woman agreed to with this private lender is $4,075 a month. We took her exact example and put it through our software. If she would have come to us and applied for an income driven plan, we would have reduced her payment to $256 a month, and she would have had only 3 years left to pay on the debt.
Yeah, you talk
Now
about
she
being
has
able to
20.
qualify. That's a massive,
That's a mortgage.
massive difference. Yeah,
Significant.
Mm-hmm.
yeah.
And
Yeah,
monthly payment, that affordability is really, what
Just trying to get a
Americans
word
live
in.
on. They don't care about how much
exactly.
in debt you are. It's just how much you can afford monthly, which is
Yeah.
the way of
And
thinking.
nowadays, with the rates that you guys are seeing, the price of homes that you guys are seeing, simply by reducing this student loan monthly debt, you now have combated the rate because you've taken away that almost 50% of that student loan payment. So if you have a millennial that's trying to buy a townhouse, they're on the sideline because they have, come October 1st, a payment coming due that they know they can't budget for. So now it's taking away from their down payment. Say they wanted that townhouse. With this student loan debt, they can't afford the HOA, so it puts them on the sideline. So addressing the student loan debt is huge. The second story is kind of more happy.
We'll take
A
one of
little more
those.
cheery. We met with a young lady. She, unfortunately, it's her first year out of school, and she's making $42,000 a year. Her and her significant other were trying to buy a home. She reached out to Nelnet to find out what that payment would look like come October 1st. She has $200,000 in student loan debt, and they told her it would be almost $1,500 a month. Well, she started crying because, one, that's her rent, and now
Yeah.
she can't sleep for her home. She ended up meeting with us. She was very upset. She was crying. By the end of it, she had such happy tears because we reduced her payment to $198 a month by simply taking her from a standard direct federal loan into either a pay as you earn, a repay as you earn, which we're going to talk about a little bit later, and or like one of the other IDR plans. By simply placing them in the right federal plan, we do not extend their term and we do not increase a rate. It is all based on moving into the correct program that's available for them based on their individual situation. So that was a happy story.
Can I hop in?
Yeah.
She was wonderful.
Janine, can I hop in
Yeah.
for a second?
Yes.
What is so? Is this something that loan officers are paying for, or are borrowers paying for?
Well, it could be both, actually. I can tell you that
Okay.
right now with the student loan consumer experience, it's $249 annually. Our student loan advisors meet with them on a one-on-one. They can either meet for 30 minutes to an hour. They can meet multiple times throughout the year if they need help or if their situations change, they lose their job, etc. On our lender side, we have a standard dashboard that allows the lender to go in and get what is called a lead capture link and invite clients. There is no cost to that. We also have a premium community membership that opens up all kinds of marketing, social media assets, a direct to consumer nurturing campaign, email templates, and that's $397 for the year for the loan officer. So we offer a standard with no cost, which gives you the access to invite your clients, use the calculator, and the lead capture link, which is huge.
Right.
We have loan officers using that all over. And a lead capture link is literally a widget or a URL that is attached to your NMLS, can be used on all your social media. So if you're in a meeting like this today and you had gone and met and did a presentation with realtors, or maybe you've done it with your other lender partners, or you've done it with a first-time homebuyer group, you place the lead capture on your social media and put a banner above it that says, do you need help with student loans? The minute that the consumer clicks on it, it attaches to you and your NMLS through our system. They can enter in their federal student loan balances and their income. It will calculate their payment within $5 and ask them if they would like to reach back out to you. They say yes, and you and I receive an email for a new lead. So it's a way to drive business for our loan officers and get this market into your pipeline. So that's, yeah, we
And
do
even
offer
more,
several
even
options.
more. So it's going to be like an internal platform, and I can speak to having used it, right? And you can input it for your client. So if you have a client that has that $500,000 student loan bills, and you're trying to assume what their payment's going to be, but they're not set up on a payment because it's been a deferment for 2 years, and you don't know what they're paying. They don't know what they're paying. They don't know when it's coming up. You can at least run through it and say, here's your income. Here's what I would expect it to be. you can pay the 249 and work with my loan sense, and they're gonna, hold your hand through the process. But what I can speak to with Genene is that they're going to do, in the closing time frame, they can go and help you get the letter from the federal student loan that's going to say specifically what that new repayment plan is, and that's going to be the letter that underwriting will accept, which makes a really big difference versus just trying to kind of blindly put it as a condition or ask your client to go out and get it, because they're going to take their time. They don't understand the time frames. They don't understand who they need to ask or what they need to go through. But having someone to actually hold their hand and get the exact documentation you need on an urgency is going to, make or break a closing.
So for
I'm going to go into
real
ahead,
quick,
Randy.
So for people that are using this, for borrowers that are using this, are they paying just once for the year, or is this a reoccurring every year type thing
She
for
had
them?
said annual.
It's a great, but it's a great question. I can kind of go a little deeper on that. It is the 249 the first time, and usually the reason that we made that cost is due to the fact that we work with many clients that we have to do what they call employment certifications, so that we can get their qualified payments counted, so they can have forgiveness after their 10 or 20-year term. So that's what we will do. Now, the following year, their situations could change. So we do have consumer tiered pricing where we may only need to do one employer certification. They may have gotten married, and we may need to do two separate, the husband and the wife may have debt. So the tiered pricing, it could be $97, it could be $49, it could be $249. It will all depend the following year what that student needs.
Okay, got it. Awesome. Well, if student loans were a food dish, what would they taste like, and why?
Right now, ooh, bitter. Are there bitters? Can I say bitters?
Yeah.
Wilted spinach.
You need some whiskey with that bitters.
Oh, yes, exactly. We definitely are going to need the whiskey with it for sure. And the reason I say that is, Katie had mentioned, we've been on a deferral for 3 years, right? So nobody has thought about this debt for 3 years. I actually have worked with a debt management company recently that had 20,000 people on a debt management plan for the last 3 years and never included, not even 0.5% or 1% like Fannie and Freddie, the student loan debt into the debt management. That's a scary thing. On average, September 1st, so we're less than 26 days away. September 1st, 45 million students are going to receive a letter from their servicer saying that their payment is due on average. And this is from very basic information. We're getting more from one of the GSEs currently, and it's getting a little scarier. But on average, the letter will say they owe $350 on average. Throwing a $350 payment after 3 years of not having to pay it, a person may have gone out and bought a new car. Maybe they bought a house in the last 3 years. Now this $350 plays into that payment. One, they are going to have a very difficult time refinancing because their debt ratio now has just increased. One, if they're trying to purchase a home, their savings has just been decreased by $350. So we are worried about defaults. We're not going to see those credit reports anymore with just zero payments. And as an old underwriter, I was like, 0 payment, 0.5% Freddie, or FHA, 1% Fannie, go. I'm done. I'm underwriting.
Yeah.
It's not going to look like that anymore. The only zeros we're going to see on the credit report are those students that are currently in school or in the normal 6-month deferral. All of the others, you're going to start seeing your standard loan payments. When you go on our calculator and you put in the average student loan rate for a graduate student right now on bank rate is between 6.74 and 7.99%. If you take $110,000 and you charge them 6.5% on a standard direct loan, their payment is $1,249 a month. That will absolutely affect our industry, not only us as lenders, loan officers, realtors, but it's going to keep people on the sideline for a really long time, especially our millennials. It will delay them anywhere from 6 to 8 years from buying a home. So they're looking in their 40s to buy their first home due to student loan debt.
Wow.
It's huge.
Are you seeing people prepare for this, or does it seem like a lot of people are getting caught off guard?
That is such a good question, Greg. We have our repeat customers. We've currently helped over 7,000 consumers. They are on top of it. I can tell you through multiple conversations, even personal conversations with friends, most have ignored it, and it is becoming a shock.
Mhm.
They are calling
I feel
servicers.
like
We had some
I haven't even seen like announcements of it being October 1st. Like I had to
it,
search to say where is that going to be. So if you're not getting that letter in the mail, and I think I know I told one of you, but there was a client that said, "Oh no, my loans were sold, like they're forgiven," and it's like, no, that's not how that works. It doesn't mean that it's forgiven.
Oh,
no, we're getting so many people. And then there's also the default side we have to consider. Okay. And you just mentioning the fact that it's really not out there. And what's coming out there is so confusing. You know, people kept hearing about the politically charged side of the carte blanche of 20,000 forgiveness, and they were waiting for that. Well, that's been denied. That's turned down.
mhm.
So they don't understand that these payments, they are coming back into effect, and those that were previous in default. So for the last 3 years there was no interest, they were not reporting to credit for defaults, and they were not doing it on cavers. Okay, they were holding off as a
Mm-hmm.
pandemic pause. Come September 1st, all that goes away. Now supposedly the DOE has agreed not to put defaults on the credit report for a year. That has not been completely written out yet, but we're waiting to hear that. However, it will be on your cavers. That means that if you try to do an FHA loan, VA loan, you're not going to be able to do that. And usually you have to rehab the loan, which means that loan officer, that lender, and that borrower, and that realtor in some cases have to wait 9 months because they have to make 9 months payments.
Yeah.
There is a program
Yep.
coming out called Fresh Start. Okay, usually when a person is in default, you can only come out of default once in your lifetime. However, because of the pandemic pause, there is a program called Fresh Start starting September 1st. It is a program that will last for 1 year. So if you come across somebody who is in default with their student loan payments, I would want you to reach out to our platform right away, because we will take them and we will put them into a Fresh Start program, clear the cavers, and make sure it is nothing on credit saying default, and we will put them into an IDR program immediately. They are not required to make a first payment,
Ah.
second payment, third payment. They will automatically get approved. So it will bring some more people off your sideline. I do want to mention, which will kind of tie back to something Katie had said earlier, we can get that done within a 21-day period. However, that does take longer. So if you have somebody in default, you want to make sure you get us to us right away, because it will take that 21 days. In most instances, when they're not in default, we can get that approved payment letter to you within a 2-week period. And that would go to you, your borrower, and it would be on the dashboard as well. That way
Janine,
you could get
I got to thank you so much for your time. I feel like we could make this an hour and a half podcast and keep going.
I know.
I will say this about student loans, and I've been talking about it for months, is that when you borrow money, it's got to be paid back, right? Whether for whatever it is. And this is going to be a rude awakening for a lot of people. And I think you've definitely provided us with a lot of great information, and hopefully the loan officers and realtors listening to the show look you up, send some business your way, keep you busy, keep you doing what you're doing. Really thank you for all your time today. Before we let you go, can you give us a best way to contact you, how people can get in touch with you and maybe get a demo?
Absolutely. You can reach me. I'm going to give you my email address right here, so that way everybody will have it. It is Genene at myloansense.com. So it's GENENE at myloansense.com. You can email me. My Calendly link will be on there, and I will be able to set up a demonstration. I also hold weekly demonstrations every single Tuesday to groups all over the country. And I can do individuals as well, because there's so much more information I would love to give you.
Fantastic. Well, thanks so much for joining us. Go ahead and hop off the Zoom
Absolutely.
call, and we'll wrap things up. We'll let you know when everything's live, and then you'll be able to share it with folks in your peer group and other loan officers.
Thank you so much for inviting me. I had a great time.
Yeah.
Thanks,
Yeah,
Janine.
of
Thanks,
course.
Janine.
Thanks,
Yeah.
Janine.
Bye.
Bye.
Oh, we're going to play a little Did You Know on student
Did
loans.
you know?
Did you know? I didn't know.
Student loan. Did you know that student loans started in 1965 with the Higher Education Act of
Okay.
1965?
Okay.
Oh,
Yeah.
sorry, Randy. I thought you froze. So I looked up the time cost of the 4-year public college at that time in 1965. It was $358 for 1 year, which in 2021 dollars would be $2,440. So a little bit of a difference when they started.
How much
issuing
is
student
school
loans
now?
for this.
How much is it annually, would you say? I mean, if you had to
Annually now?
guess. Yeah. It was like average state
Well,
school
I have the graph. It's like 9,300 now.
per
per
year.
year.
Oh, man, that's not that bad. That's
For
not that
public
bad.
school.
Just like 3.5 times more.
Yeah.
Not bad.
Did you know that federally backed student loans cannot be included in bankruptcy? So if you go file bankruptcy because the student loan payments are hurting you, those federally backed student loans, they're there for life.
Too bad.
Oh,
Yeah.
scary.
And we are going to see a lot of folks going into bankruptcy in the next year or two, in my opinion, just based on credit usage and high interest rates right now. I mean, trying to get a stem on inflation. Then you add in the mix the student loans. This is, I really enjoyed what Janine had to say. Greg and I were having a thumb war over here trying to see who could get in first. But she's very passionate about what she does, and I think there's tremendous value in that for a few bucks ultimately in the grand scheme of things. I mean, hearing that person that had $4,000 a month student loan payment and like that's it, you're done,
Yeah.
versus just a
Yeah.
few $100, that's massive. That is
Wow.
massive. Did you know that Fannie qualifies 1% of a student loan balance if there's a zero payment? And I imagine we're going to see some changes to this after October rolls around. Freddie's at 0.5%. FHA and USDA are also at 0.5% of the payment. And Katie, you put something in the script here about calculating VA student loans. How does that work?
VA student loans is a little more unique. It's 5% of the balance divided by 12 months. So it's actually 1/12 of 5% is going to be what you can use as your assumed monthly payment if there's a zero.
So do the
Can-
math really quick. What is 1/12 of 5%?
What? I don't know.
Depends on what 5% is.
Yeah.
of.
Okay,
You
so can
stumped
you
him.
guys explain to me how this works? So, assume monthly payment, 0.5%. Can you explain this to me a little bit better?
In layman's terms. So
Yes.
if I look at a credit report and the combined total of student loans, let's say the balance is $100,000. 1% of that is $1,000 a month. That's the payment that I use for qualifying. If I go Fannie, if I go Freddie,
If the credit report shows that there's a zero,
Right.
that there's no payment, we have to assume a payment.
Right.
We can't say, oh, they actually don't have to make that payment.
I see.
Yeah.
That's where this comes into play.
So is that going to change once people are paying their student debts?
yes.
Okay.
Yes.
Got it.
Were you not listening to Janine at all?
I'm just confirming.
I
the
will call her
information
back
here.
right now, Greg, and we will do this
Bring her
all
back in.
we will do this all over again. Yeah, I mean, this is going to be big. Things are fairly slow in the industry across the board, but I mean, I think this is going to be something that keeps a lot of people busy. And quite honestly, what a great way as a loan officer and a realtor, Greg, I'm looking at you. I think what a great way to market yourself to those who are thinking about buying that need to get a head start. I mean, so much of my book of business are people, first-time buyers, right? And sometimes I work for them for 60 days, 6 months, 2 years before they buy their first house. And I will say this about the millennial generation is they tend to be more prepared and forward-thinking than we give them credit for. Well, nobody's really talking about the student loans because we were all hoping that they would be forgiven, and they haven't. I would say that millennials growing up in the generation. Am I making a fair assessment? I mean, Greg and Katie, you guys are both millennials.
I think so, and I would
Mhm.
also say that our whole industry. Sorry to completely divert, but it's just getting that sphere of influence, right? So if you're just encouraging and educating your clients on how to pay attention to student loans and how to be best prepared for it, you're going to have business to come 2-3 years down the road. It might not be an immediate reward, but it's going to be that long-term effect because they're going to be better prepared,
Right.
like you're mentioning.
Before we go into the news, Katie, where are you zooming in from?
I'm in Seaside, Oregon, and it is some beautiful, lovely rain. Rain.
Oh, I love rain. You're very
On the coast.
you're very pixelated.
Yeah, and it looks like you have two big bicycle wheel ears also.
I do have bicycle wheel ears. It shouldn't be too pixelated though.
Shouldn't be. Okay, well let's do some news. There's a lot of news to go over.
A lot.
Yeah. All right. Well, jobs growth. What's that all about? Jobs number for ADP blew away the mark,
Continuing strong.
but non-farm payrolls missed the mark. But the revisions beat the mark from last month. So quite honestly, I don't know what jobs report to believe. I'm just gonna sit in ignorance. I have nothing to add. Literally nothing to add on jobs growth. People need to work if they're going to pay their student loans.
Definitely. National rents were down 0.7% year over year in June, and vacancy rate hit 7.3%.
That is really good news to see rents going down.
Yeah.
That is a precursor to falling inflation.
Falling inflation. Also, foreign buyers have been around 2.3% of the residential buyer pool historically, but year over year, we've seen them down 14%. So international buyers are like, I'm getting out of this market.
CPI is due
really
out
wild.
tomorrow. Any predictions? What's your predictor say, Katie? CPI going to come in
It'll
at target,
continue
below,
to
or hot?
improve and nothing will change. Probably
gosh.
at target.
Yeah, you're
I
drinking the
expect at
Kool-Aid.
Target.
You putting whiskey in your Kool-Aid again? Okay, don't answer
In my
that.
cup right here. I got
Yeah. Here's a really fun one. 10 mid-sized banks yesterday had their credit downgraded by Moody's. That's a big deal.
Mm-hmm.
So we saw trading bonds and mortgage-backed securities were in the green yesterday for my birthday. That's right. I turned 44 years old yesterday. If anybody wants to
Don't look again.
If anybody wants to send me a birthday card or chocolates, I'm down for that. But yeah, so 10 mid-sized banks their credit was downgraded, and a couple of larger regional banks such as U.S. Bank, Fifth Third, and Citizens Bank have been put on notice.
Ooh.
Yeah, they're teetering having their credit downgraded, which kind of makes sense if you think about it. Right, U.S. Bank
It
has
does
been
make
doing
sense.
locally,
Yeah.
has been eliminating some jobs and doing what they can to sort of stave that off.
Hedge their bets.
Yeah. CNBC reports that mortgage credit availability sinks to a 10-year low.
That's a big deal. Nobody's really talking about that. Katie, do you know what that means?
That it's
Allow me to
slow.
explain. No, allow me to explain.
Yeah, please,
No,
Randy.
mortgage credit availability, not mortgage applications. The credit availability, right? Things are getting
Oh no! Please
tighter.
explain.
Mm.
Things are getting tighter. Construction loans have all but gone away. One-time construction loans are nearly impossible to get. Banks are shutting down their lending avenues incredibly, right? So with so many banks getting out of the business, those of us who are brokers or lenders, well, we're gobbling up market share. So it's good for us, bad for the industry.
Are we seeing certain products go away?
Oh, yeah. Oh, yeah.
Oh, really?
Yeah,
Okay.
lots of products going away.
Oh.
Yeah.
Fun.
Katie, do you have anything left for us in the news?
The last one. Philly Fed President Harker
Mm-hmm.
intimates. I was trying to.
Oh my
read
God, let me
that.
do this for you. You are
Yes, I would like you to.
Philly Fed Pres Harker intimates, right, eludes that rate hikes are at an end,
I don't know about that.
contradicting what the Fed Governor Bowman said that he expects additional rate increases. ... WTF, if we're reading that together. Nobody
reading it.
really knows what's going on. It's all going to be data driven. I'm still sticking by 8%. We haven't hit it yet. It's going to be a slow, cold winter. Those of us that can make it through, we're going to gobble up market share, and we're going to be better because of it. Our listeners might be going down in numbers, and that's okay. They'll be back when it's time for a refi boom.
Hopefully we're entertaining enough.
Yeah. Rates
Stick around.
rates are almost identical to where they were when we recorded back on July 27th.
You know what else is funny? I looked up an old script, and we had March 5th was almost identical as well. So we're back to where we were in March.
Yeah.
Oh, wow.
Hey,
Very nice.
Thanks for joining us. Katie, thanks for setting up Genene with Loan Sense. Yeah, no errors from our last show.
I think it's a fun one. Good one to look into. And if you guys have any opinions on it, you can message us on Instagram, watch us on YouTube at the Truth in Lending Podcast.
Fantastic. Well, Potato Heads, have a beautiful, beautiful August 9th. And let's all root for CPI to come in nice and cool tomorrow. Let's see rates get just a little bit better.
Yes.